All right, so we're live now, Cyra.
Okay. Hi everyone, thank you for joining. We're just going to wait a couple of minutes to let everyone else join. I know we started a couple of minutes early, which is not like us at all. So just hang tight, we'll get started in a little bit.
Okay, good evening, everyone. Welcome to another edition of the Finance Medic from mindthebleep.com. This will be featuring Dr. Cyra Asher, who is an academic foundation trainee in the Oxford Deanery. Dr. Asher is also a qualified chartered accountant and has been providing us with lots of useful information and Q&As over the last roughly 7 or 8 weeks now. As always, if you have any questions at all, please do comment on the video on Facebook, and I'll be monitoring that, and I will pass that on to Dr. Asher and also our guest this evening, Tom Davies. Over to you, Cyra.
Thank you, James. Welcome, everyone. Thank you so much for joining this evening. I know last week we had a little bit of a break. That's because I have started finally as an F1, and oh my God, it's hard. It's intense. Feel free to comment. Feel free to ask any questions, how it was, or just tell us about how your experience was of your first few days. I thought I was prepared. I thought I'd done all the shadowing I needed to do, but clearly not. So we're just going to jump straight in. This webinar is about mortgages, and mortgages is a huge topic. It covers everything from the first-time buyer to remortgages to people who want to purchase a property and rent it out. So I decided the best thing to do was to actually narrow it down to first-time buyers, because others who've had mortgages before will probably know a lot of the information I'm about to talk about anyway. And those at our stage of training, so around the leaving med school, the early foundation years, will probably be first-time buyers. So I'm hoping I've covered the topic at the right level. But what I wanted to introduce, first of all, this is what we'll be talking about. We'll be talking about what a mortgage is, the types of mortgages available to first-time buyers, what repayment structures look like, what the difference is between a fixed rate and a variable rate mortgage, and information that's specific to healthcare professionals. I am extremely proud to introduce Tom Davies. Tom Davies is my mortgage consultant, so he's tried and tested, and he's excellent. He will be actually providing us with support. He'll be jumping in with nuggets of information, and he'll be also covering the Q&A at the end. So please fire all your questions in the comments to him. He's worked with doctors, locums, healthcare professionals, nurses. So he knows what he's doing when it comes to the mortgages for the healthcare provider. Tom, would you like to just say a few words?
Yeah, absolutely. So, I mean, just give you a brief introduction of who I am. You know, I've been in the financial industry now about 5-6 years. So, I deal with a very wide range of different types of clients. So, I predominantly deal with a lot of staff from the NHS. So, like you said, local doctors, also do a lot of nurses. And what you tend to find is there are various different types of income types and different routes that people go down. It's quite a specialist industry. So yeah, it's really important to get the advice right the first time. And especially when you're doing something as sort of delicate as a mortgage, it's important to speak to someone, you know, like myself, who, you know, deals with this sort of day in, day out, because different lenders will look at different things. with a different sort of light and a different level of perspective. So I've looked through the slides, and we're going to hit quite a lot of key points within this presentation. So I'll let you crack on with it, and I'll jump in. I'll try and give some information where I can, and hopefully shed some light on the whole situation.
Lovely, thank you. I will have a slide with these exact same details at the end as well. So if you want Tom's information, it will be available at the end of the webinar. So you don't have to scrap and try and write it all down at once. Okay, let's jump straight in. What is a mortgage? A mortgage is a specific type of loan that is given to you to buy a property. So the average term for a mortgage is 25 years, but it can actually be whatever you want it to be. You can have it for less. Usually if you're an older buyer, they prefer that you have a less amount of time as your term. You could have it for longer, not very often. And it's a secured loan, which means that it's secured against the property that you're buying. And therefore, if you fail to make your payments and you are consistently missing payments, they don't just repossess straight away. They give you a few chances. But if you are unable to make your payments with a mortgage, your home may end up being repossessed, because that's what the loan or the mortgage was secured against. So factors that affect your chances of actually getting a mortgage. So if you all remember many, many moons back when you first met me, I did that webinar on the credit score. That was basically to help you understand how your credit history is going to affect whether you get a mortgage or not. They take a close look at your credit history because this is probably the biggest loan you're going to take in your life. It's not small amounts of money, and it's actually quite risky. So they look very closely at your credit history, and actually this is where the most unexpected snags can occur. Something from your past many, many years ago that you had no idea existed can creep up and sort of delay your mortgage, or mean that you can't actually get a mortgage the first time round, which is why it's so important to take a look at your credit history, scan through your credit report with a fine-tooth comb and make sure it's all accurate.
Can I jump in for a second there as well?
Yes, of course.
Just to give you a bit of history and an idea of the way that lenders will look at this. So they have access to the last 6 years. They can go a little bit further than that if they wish to. So it's really important that prior to a mortgage application that you seek a report. Okay, so most lenders will look at 3 different types of reports. They'll look at Experian, Equifax, and TransUnion. So they can use different combinations of those 3, but they tend to just stick to sort of Experian, but that's obviously dependent on what lender that you proceed with. Now, the reason why it's so important as well is because when you go to an underwriter or a lender, that's what they're looking at. They're looking at black and white facts on paper. So your credit history is basically defining who you are and your credit worthiness. So what I tell all my clients, I mean, I deal with a lot of people as well who are in situations where they might not be able to get a mortgage now, but with a roadmap of, I don't know, 3, 6, 12 months, even sometimes even 2 years, I can sort of direct them in a way where if you do X, Y, and Z, ultimately, you're going to be in a position where, we can look to secure the funds. Now, what a lot of lenders will do, looking at your credit report, is they'll look at the facilities available. So for instance, if you've got a credit card with £1,000 on it and you're using £950 of it, you're using a lot of your available credit. Now, on paper, that says to the underwriter that, although you're using credit and you're not going over the limits, you're still using it up to the maximum available. So when you're looking to do a mortgage application, it's important to keep your available credit, still use it, because it's like a catch-22. You still got to use it, but you can't overuse it, because when someone sits down and looks at it and they don't know you and they don't know your circumstances and why you've used it, they'll say, you've got £1,000 here, you're using nearly 1,000 of it. Can you manage your money well? So that's a really key point. And I think that, like you rightly said, that's where a lot of skeletons come out of the closet. And it's important to look at that sort of, plan it 6 months before, 3 to 6 months before, so you can line everything up. And when you come to the application, you're going to be in a good position then to have everything cleared off, your finances in all of your ducks in a row. And it just makes for a much smoother process. So that's my top tip on that.
Thank you, Tom. That was really, really useful, actually. Yeah. Thank you so much for that. So the next bit, I looked at some high street mortgage lenders, and a lot of them were coming up with the same thing, that they wanted you to be in a permanent full-time employment. Now that's not the same for us. For example, my F1 contract just runs for 1 year, and then I'll get another contract for F2, and then another contract for core, whatever. So it's not as straightforward for doctors as it is for people who may work in normal, like, private sector. But Tom is going to discuss how you can get around this, and how, for example, locums, it works a little bit differently. Is there anything else you wanted to add to that, Tom, before we get there?
Yeah, I'm not sure how in depth you want me to get on this slide in particular. I mean, do you want me to sort of gloss
Yeah,
over?
go for it. Yeah, of course.
So, like you said, most lenders will want you to be in a permanent position, because obviously, that shows longevity and that shows security moving forward, because they're going to lend you, hundreds of thousands of pounds in some instances. So, yeah, that's what most lenders want. Now, off the back of that, working in this industry and sort of specialising in different incomes, what you tend to find is, when you package the case correctly and you choose the right lender, and you can provide a narrative behind it, you can use income like locum work, for instance. I mean, the problem is a lot of lenders will want to see 2 years, but some lenders, some providers might only want to see 12 months worth of history. So as long as you've shown that, for instance, bank work as well. So that's technically a 0-hour contract, isn't it? Yeah. So off the back of that, most lenders want to see 24 months worth of it, and P60s to back it up, to make sure that each month, each year, you consistently hit an average sort of income. Now, there are lenders out there that will look at a 12-month history and go off the back of that. And there's also various different routes that doctors take. So umbrella companies, for instance. So again, with that one, there are various different options and different routes that we can take. And ideally, I can source mortgages with 12-month history. So ideally, that's when you want to start looking at it on the run-ups to, on sort of month 10, 11, and 12. That's where you want to start getting advice and coming forward, and then it ties in with the credit history then, so we can look at the credit report and basically get it ready for the 12th month. So, yeah, that's...
Thank you. We'll, there is another slide on this a bit later on, which we will provide a bit more detail on. But that was basically it, that actually there are lenders who will accept less history, but as long as you're planning it in the right way and you approach a mortgage broker at the right time or early on, they can help you come up with exactly what you need to do for your application to be successful. The next point I was going to make is your salary. So the salary that's used normally is the salary that's in your contract, your basic pay. So we get our weekend premium, we get our out of hours, we get our overtime, etc. But I think what Tom's going to tell us a little bit about is actually if we can prove that we consistently get that added amount over our basic salary, that can be incorporated into our multiplier. Is that right, Tom?
Yeah, absolutely. So what a lot of lenders will do is they'll look at the last sort of 3 months worth of pay slips. So if you've got shift allowance on there, or call out, or whatever above and beyond your basic is, they can add it all together, divide by 3 and times by 12, so then they can annualize figure of it. Most lenders will use around about 50 to 60% of this, depending on who you go to, and they tend to back it up against P60. So this is where, obviously, it depends how much you're looking to borrow and where your affordability sits. But let's say it's quite tight on affordability for the mortgage you're looking to secure. If you're looking at 3 months pay slips annualized, what most lenders will do is they'll look against the P60 figure, and they'll take the lesser of the two. Now, in previous cases, a good way around this is there are some niche lenders out there that will use a 6-month average if it's better than the P60. So let's say, it's August now, okay? So let's say you just started this role in January, and you've been working really hard. It's really busy in healthcare at the moment, isn't it? So naturally you are going to be putting a lot of extra hours in. So instead of using 3 months pay slips and comparing it against a P60, that's not really reflective of what your earnings are moving forward now. You know, we can use 6 months and make an annualization of that as well. So, you know, that's really helped a few of my clients obtain what they need to obtain. And on multiples of salary as well, there are a few different lenders out there that will look at, they tend to call it the hero range, which is quite a nice name. I like that. But with the hero range, what they look at is, so they look at professionals, they look at like nurses, doctors, even police, blue light services, and various other sort of service personnel, and they can use up to 5 or 5.5 times income. Obviously, that is dependent on credit score and dependent on other circumstances. So that again is just another tool in the arsenal to basically, you know, get you guys what you need in order to secure the house that you're after. Does that make sense? If I explain that properly.
Yeah, thank you. So basically the point we were both trying to make is that you have normally it's around 4 or 4.5 times your salary that they're willing to lend you. But for doctors, nurses, and other blue light personnel, there are certain lenders who will actually go up to about 5.5 times your salary and lend you that. Absolutely. Which is fantastic. It adds a lot of money and gives you quite a lot of leeway in the kind of properties you can actually look at when you can get that little bit more on your salary. And then deposit. Now this is based for just first-time buyers. It's not specific for healthcare professionals, but for first-time buyers, there are mortgages that the deposit is as low as 5% of the property value. And these are specific for first-time buyers. The higher deposit you can pay up front, the better terms you'll get, because they're having to lend you less than what you would be getting if you had only 5% deposit. We'll talk more about the Help to Buy scheme, which helps you get a better mortgage rate by helping you with the deposit. We will talk about that later, but the minimum you need is 5% of the property value that you're looking at. Okay, so, look at this lovely couple. So types of mortgages for first-time buyers. So there are 3 types of mortgages that I'm going to discuss. There are actually more. There's ones for right to buy, which is for people with council houses. I'm not going to discuss those. You can research those, and I've put some resources in the article, which will be published a little bit later. But the ones I will discuss is the first-time buyer ones, Help to Buy, which might be quite interesting for a lot of us, and Guarantor. So first of all, first-time buyer, this is sort of available to all first-time buyers. You don't have to have a special account for it. You don't have to have anything sort of specially lined up for it. As long as it's the first property that you're buying ever, you are a first-time buyer. They have lower deposit requirements, so between 5 and 10%. 5 is definitely the lowest. It's usually 10%. And they are a higher loan to value, which is what LTV stands for. And it's basically just the percent of the house price that the lender's loaning you. So if you've got a 5% deposit, they're lending you 95% of the house value. If you've got a 10% deposit, then it's 90% of the house value. That's what loan to value means. And the things to remember is that even if you have the 5% for the deposit, there are actually lots of other costs you need to keep in mind as well. You need to be able to afford those costs, which we will discuss a little bit later. And the lender will also check your affordability. So it won't be just the fact that you have 5% of the deposit and you've got the salary that they need to give you the increment to then loan you the right amount. It's also whether you can afford to repay them. So they'll look at your income and your expenses to make sure that your expenses don't mean you're not able to afford the mortgage payments. And they do look at those in detail with you. So things like childcare costs, travel costs, things like that, they will take those into account. So it's not just the other basic information they'll use. And some lenders, there's only one at the moment, that they have additional requirements of where your deposit comes from. So some lenders say you only can use a deposit that you saved up yourself. I believe this is only just one lender. So for example, if your family is helping you out, you need to be careful about how it works, how you're going to declare it, because they will ask where the money's coming from. And this is all for money laundering laws. They have to do this. Tom, do you have any insight on this?
Yeah, it's a lot of lenders will want it to be an immediate family member. So, second cousins are is one that I come across quite a lot now. Although they are, people can be really close, it's not an immediate family member. So ideally, you're looking at your mum, your dad, brothers or sisters, or sort of step brothers or whatever it is. So I mean, there are some lenders that will accept deposit from friends, and there's even one that will accept a loan as long as it fits the affordability for alongside the mortgage. But what that does is it pigeonholes you to one lender, and you're not going to have access to the whole of the market. But rule of thumb is if you're going to get a gift, keep it within the family. And it's non-repayable as well. A gift by definition is a gift, so they hold no financial interest. Okay.
Yeah. So a few more. If you have any questions about that, just stick that in the comments and we'll clarify that. The next type of mortgage is Help to Buy. So this is a big one for first-time buyers. Help to Buy, it's a government scheme that can help you buy a mortgage with a slightly smaller deposit. If you're buying a Help to Buy property with Help to Buy, you need at least a 5% deposit, and the Help to Buy scheme fixes the multiple of your salary at 4.5 times. So it's not, you can't actually go to the other lenders that Tom was talking about where you have 5.5%. It is fixed at 4.5%, and so your salary needs to be enough so that the 4.5 times increment is going to be enough for you to buy the property you want. So you use a Help to Buy ISA, which is now no longer available. If you have one from before they stopped doing them, you can use that and continue to save up in that as you want. But now you have lifetime ISAs available. Check out the webinar I did on savings because that will clarify a bit more about them. But basically, you use your Help to Buy ISA or your lifetime ISA to buy a property, and the money that you have saved in either one of those accounts, you get a 25% bonus from the government on top of the money that you've saved. People always ask me, can I use both and get 25% on both those balances? The answer is no. If you end up using both accounts, you can only get a 25% bonus on one of the accounts and you forfeit the other bonus. So the best way to use these is to use your Help to Buy ISA when you're buying a house and get the 25% bonus for that, and then wait until you retire to get your lifetime ISA bonus. And that way you maximize the two accounts. If you just have one of them, then use it to do what you want to do. If you have enough to make up your deposit without it, I mean, this is a lifetime ISA, then wait for your lifetime ISA, keep saving up in it and use it later on. Otherwise, you can use it to buy your first house as well. So for certain, there's an extra little bit here I've written about equity loans. Now, this is to do with new builds. And what happens is you have a 5% deposit. The government then loans you another 20% of the property value that you want to buy, which means that's a 25% deposit for the bank. And then you're taking a 75% loan to value mortgage, which means you are borrowing less than you would have borrowed with just a 5% mortgage. The way the government benefits from this is when you sell your house, they get 20% of the selling price back. And if your house has increased in value, they get more money back. There is a cap on the price of the house based on your location of where you're buying. And the 20% equity loan is outside of London, and then there's a 40% equity loan in London. Tom, do you want to add anything there before I carry on?
Yeah, so with the Help to Buy, I'm actually on the government panel for the Help to Buy, and my company, we deal with a lot of new build developers across the South Coast, and it's a brilliant scheme to get you where you want to be. And just touching up on the loan to values that you mentioned earlier, so quite rightly, like you said, the more the lender will lend against the house, obviously the more risky the business is for them. So, obviously the higher the interest rate, which is going to mean higher monthly payments. So I think the beauty about this scheme is where you're only providing a 5% deposit yourself and getting the 20%, from the government, your loan to value is going to be basically right in the sweet spot where you're going to be getting the best rates in the market. I mean, I secured someone this morning with the Help to Buy products. I think it was about 1.51%, so extremely low in comparison to a 95%, which you're looking at high threes. So for first-time buyers, it's definitely a very good step in the right direction, and it does set you up for the next 5 years. It will get you that extra room rather than buying the smaller property and then wanting to move out in 2 years and start the process again. So it's a really good scheme, but also bear in mind, guys, that with the Help to Buy, this is how I illustrate it to all my clients. So the Help to Buy scheme is you have to meet their criteria before you even look at lenders, because lenders tend to lend more. Lenders have different affordability scales than what the Help to Buy is. So Help to Buy, it is an affordable housing scheme. So I use the analogy as it's like a shop front window. So you've got to go through the front door, which is the Help to Buy affordability calculator and the financial assessment. And then once you're through that door, then you can start looking at different lenders, and depending on different income types, you can then have a pick of the bunch. So it's really important if you are looking at new build and Help to Buy. Obviously, come speak to me or the guys here, and we can fully qualify you and give you more information on it, and sort of guide you in the right direction. But it's important to have that information first, I think.
Thank you. It's a fantastic scheme. So whatever you can do to kind of make sure that you do qualify for it, do, because it's such a good way of getting on the property ladder and getting something really worthwhile for your money.
Yeah, and it's stopping soon as well. So it's good to get on that.
How soon?
When is it exactly, Paul? That's my stopping. Sorry.
Thanks, Paul.
Reviewing it next year.
They're reviewing it next year. Paul says hello. So they're reviewing it next year, and it's to our. We reckon it's going to keep going, but there's no guarantees with it. Yeah. So definitely get on it sooner rather than later.
Yeah. Cool. And then the last one I'm going to talk about is Guarantor loans. This is so you can buy a property with small or even no deposit. Now, I don't know how easy these are to get. So basically, a family member or a very nice friend, I have lovely friends, but none of them are going to give me this much money, will have to agree to be named on the mortgage, and they will cover your repayments if you miss them. They have to guarantee the mortgage repayments if either your property is repossessed, which means you can't pay for the mortgage, and their savings. So either they will secure the mortgage against their own property, or they can put their savings in a savings account with the lender until a certain percentage of your mortgage has been paid off. I have never heard of anyone getting these. Have you?
Yeah, it's called the Barclays Springboard.
Okay.
Scheme. So just to keep these figures simple, let's say someone was looking at buying a £200,000 house. So Bank of Mum and Dad would put a 10% deposit down into like a savings bond, I'd call it. That would then be tied up for 5 years, and it would incur interest as well. Okay, so that will go along for 5 years, and at the end of the 5 years, they can then take out those funds, including all the interest that they've incurred. And what Barclays and the way that they've looked at this is, in that 5 years, you're going to be making payments from that mortgage. So in 5 years' time, you would have made 5 years worth of mortgage payments. You can sort of aim to hit, I don't know, like 95 to 90% loan to value. So like we mentioned before, that's a standard sort of first time, sort of loan to value scale. But also as well, keep in mind that there might be some equity growth too. So in that point in time, if the property goes up by £20,000, which is more than likely given the circumstances, that's just more money within the property in equity, and you can basically remortgage on a standard 85 or even 90% loan to value, sort of mortgage. So it's a very good scheme. It's a very good product, and we've had a good few go through here before, so it's definitely worth talking about.
Oh, excellent. That is fantastic. It was when I was doing my research I came across these. Otherwise, I hadn't actually heard of them. So yeah, I'm really impressed. I didn't think mortgage providers were so nice. So yeah, some of them are really nice.
Dave.
Okay, so repayment structures. So I wanted to sort of break down what the nitty gritty of a mortgage is, so that it's not as confusing when you're thinking about it. So there are two types of repayment structures. There used to be three, but they're not there anymore. So the main one you will probably see is the capital repayment. So this is when you make your monthly repayments and you're paying off a proportion of the interest and a proportion of the actual loan value. This is the same as a normal loan, basically. And you're doing that over your 25 years. There used to be interest-only ones where your term, for example, would be 25 years, and you would only actually be paying off the interest. So your monthly mortgage payments would be super, super low. However, at the end of that term, you'd still owe the entire amount. So you'd either have to figure out another way of paying it off at the end of the mortgage term, or end up selling the property that you were actually buying in the first place. These aren't actually available as much anymore. I reckon, is it because of the risk? How come they're no longer available?
It's just because a lot of people came to the end of their terms. So, sort of pre-2007, a lot of people took these loans because low monthly mortgage payments. Why wouldn't you? And they weren't really, no one really explained to them what the implications were towards the end of the term. So a lot of people came to the end of the mortgage term and they were like, I should have paid off my mortgage by now. Why have I still got 150 grand outstanding? And then when you're on your, when you're 70 years old and you haven't got like a pension pot to fall back on, investments or savings or whatever it is, a lot of people were made homeless, basically. Wow. They couldn't pay back the bank that loan, and they can't get a mortgage on their own merits because people, once you get to a certain age, you sort of kick back and sort of enjoy life a little bit more, don't you? You stop working. So there was big steps and strides in order to sort of stop that happening within the industry. Now, the only way that you can sort of obtain an interest-only mortgage at the moment is by having a very large income, normally over £70,000 per year, and having a very large deposit, so anywhere between 40 and 50% onwards. So what the lender's looking at there is, they want you to have a majority share within that property. So when you come to sell it, or whatever, at the end of the term, you've had a really good income for the majority of your life. You probably would have put it into pension pots and stuff. And then when you come to sell it, you've still got equity, so you can move on from that. And it all comes down to risk profile for the lenders, and obviously treating the customers fairly, which is really important. So that's why they sort of phased out.
Yeah, that's really useful. I didn't know about that. So you're more likely to have the capital repayment scheme, really. So just keep that in mind. It's just like a normal loan. It always jumps between whether it's cheaper to have a mortgage or cheaper to rent, and that just keeps going up and down. So the good thing to remember is that when you do have a mortgage, whatever money you are paying is actually going into owning your own property. It's not just money down the drain paying off someone else's mortgage. It's money that you are using to actually buy your own property and creating equity in your own property. So don't sort of look at it as how much money am I actually spending? Is it cheaper to rent? It's more how much of this rent is actually making me, gaining me equity, and actually rent it zero and mortgage it's slowly building up for you. So those were the two repayment structures, and you only have to worry about one. And then the next thing I wanted to talk about was fixed rate and variable rate mortgages. So I'm sure you've heard lots of times that when you've heard of mortgages on telly and they've said, like fixed rate this or tracker and things like that. I just wanted to clarify what those terms were so it wasn't too scary when you came across them. So a fixed rate mortgage is what it says on the tin. It fixes your interest rate for a specific amount of time between 1 and 5 years. And so when the interest rates are really low right now, which is lovely, you then know what your interest is going to be for the next X amount of years, you know what your payments are going to be for the next amount of years, and it's not going to go up and down and shock you. The problem with this is if the interest goes any lower, which at the moment, Jesus, that'd be weird, then you might be paying over market rates. So you might want to not trap yourself in a fixed rate if, for example, we were like midway in terms of interest rates, and it could go up or down. Variable rates, there are two types of variable rate mortgages. The first one, it kind of like follows Bank of England base rate, but the bank kind of creates its own version to try and be competitive in the market. And this one goes up and down. So it's not sort of a guaranteed fixed amount, and your mortgage payments can change. They will obviously tell you, but they change. And tracker mortgages specifically follow the base of Bank of England base rate plus however much percent the bank wants to charge. So as long as you know the base rate, you're going to know what your mortgage payments are. But again, these are subject to go up and down. Any points, Tom, before I move on?
Yeah, with that, again, going full circle to what we were discussing before, it's really important that when you're deciding on what rate best suits you, to have what you're looking, have a good think about your plans over the next 2, 3, 5, even 10 years. We've had people come to us that fixed in for 10 years because the interest rates were really low 2 years ago, and they're in a situation now where they've outgrown that house or they have to move for a job. And when you're fixed in, if you want to come out of that mortgage, and for instance you can't port that mortgage to a new property for any amount of reasons, you could be applicable to quite large fees. So it just goes full circle to have a really good in-depth discussion with your mortgage advisor, broker, bank, me, whoever it is, and just make sure that it's suitable for you. Because if for instance, if you're going to buy a property and you're planning to move out of it within a year, a variable rate might be a good idea because most variable rates don't have early repayment charges. So it's all about future-proofing what your decisions are and having that good upfront, frank discussion prior to committing yourself. So just keep that in mind.
Thank you. I didn't actually know about that. The fact that the variable mortgages don't have.
Most of them don't. Some of them do, but again, that's something that I would go through and double check. If that was a parameter and you told me that, then I would obviously source it based on that key facts of you don't want to pay a fee to get out that mortgage. So yeah.
Brilliant. So the other costs I wanted to mention that you're going to have to think about, as well as your 5% or 10% deposit, is you might have an application fee. There will be valuation fees, bank transfer fees. So they actually charge you money to change hands of the money electronically. My parents took a check because they were so adamant they weren't going to pay whatever charge there was for the bank transfer. So they had this very, very scary looking check for a while. Broker's fees, which Tom does not charge.
Yeah, to you guys.
There's a plug.
Yeah, we normally charge 495, but via this introduced to us, then yeah, no fees for you guys. So and that's with like NHS workers and stuff. So yeah, just to give back to the hard working people.
Sorry, Tom, did I just kind of commit you to something you don't do? Sorry.
No. You guys, yeah, that's no problem. NHS staff and doctors, and yeah, just to give back. That's what we'd normally do. So yeah.
And early repayment and exit fees, which is what we talked about. So if you wanted to leave your mortgage early, if you wanted to remortgage because you found a better rate, you might actually have to pay a charge to leave. And also in terms of early repayment, so say you came into a windfall of money, there was an inheritance, you suddenly won the lottery. This early repayment charge, can you tell me a little bit more about it?
Absolutely, yeah. So that early repayment charge is normally only applicable during the fixed term period. So let's say for 2 years in this instance. Now, this is a little known fact as well. A lot of lenders do have an overpayment facility where you can take advantage of making up to 10% overpayments of mortgage balance per year. Now, this is a really good effective rate of cutting down sort of compound interest and shortening your mortgage term down a lot more efficiently than if you were just to pay it, let's say, over a shorter term. If you were to set up a overpayment for the same difference, so went for a bit of a longer term, but so if you had a longer term, obviously the mortgage payment would be a lot lower because it's longer. But if you set up a overpayment difference, so if you were to cut it doan by 5 years, if the difference was like £200, then every £200 overpayment you make, it comes directly off the capital outstanding rather than you paying capital and interest. So so early repayment fees are applicable within the fixed term period, and yeah, if you want to make overpayments, you can make up to 10% without incurring those fees per year. On
Really
most
useful to know.
plans.
Thank you. Okay, so this was the information I put all in one place for healthcare workers. We've discussed it sort of slowly as we've gone along, but here's a bit of a summary. So you can have slightly higher multipliers of your salary, better than high street banks. You could get a mortgage as a locum or bank staff, or you could use your bank earnings to help enhance your salary to be able to get a better amount from your multiplier. I was talking about how much we change trusts and how many different contracts we have. So we can actually use last 3 months of pay slips and P60. We can use our contracts, notification of pay rises, or 6 months for a better average. So you don't have to worry with the fact that we change trusts so often that it won't be seen as like a permanent job, because the market is aware that as NHS staff, as doctors, that's how our kind of career works. So it is taken into account, which it wouldn't normally be for other professions, I guess. And then international medical graduates. So Tom, one of these experienced brokers, understands a lot about the visa restrictions that they face. So he can help a lot about all the trying to access a mortgage when you've just moved to the UK and you're trying to figure yourself out. I'll let Tom talk about that a little bit more because he's the expert.
Yeah, so this is a major part of what we do, and there are a lot of restrictions. So a lot of problems within the normal, a lot of problems are. So lenders want to see credit history within the UK for a set amount of times. Now that's normally 2 to 3 years. So a lot of people that have just come over and just started working, or they've been here, sort of 9 to 12 months, then it sort of pigeonholes them and it doesn't give them access to a lot of lenders. Now, we do have access via our intermediary network to use a few lenders that will look at 12-month history here in the UK. So incredibly short amount of time here, but that is subject to credit score. So if you're watching this and you want to get a mortgage in 12 months and you've just started working here, it's really important that you start up a bank account, you get on the electoral roll if you can, start taking credit where you can as well. So even if it's a small credit card, use it up to a good limit. So I'll probably say about 88, 85%, and then clear it back down each month. You don't want to use too much of the facilities like I explained before. But yeah, it would, like I said before, it's all how you present the case to the right underwriter in the right way to allow them to have more meat on the bone and sort of be more comfortable with it. Because again, it's all about responsible lending. So yeah, with tier 2 visas, what you're looking at is normally around about a 75% loan to value cap. So you basically need to provide 25% deposit of your own funds. Now, again, through our intermediary network, we do have access to 1 or 2 lenders that, as long as you've got 2 years address history here in the UK and your credit score is high enough to basically get agreed on 90% loan to value, we can use them. So Paul, my senior broker, who's just across from me, last week he actually secured someone in a similar circumstance, that 90% loan to value, and they moved into the UK in, I think it was 2019, I think. So yeah, it is obtainable, but it's just having that chat with an experienced advisor like us here, and yeah, us placing you in the right direction with the right lender, with a right underwriter, and yeah, it's not difficult to get it approved. It's just making sure that you know what you're talking about, basically. And there's quite a lot of hoops to jump through, but it's definitely doable.
Brilliant, thank you. We do have quite a lot of people following us who are international medical graduates, so I think that information would be super, super useful for them. Okay, so these are Tom's details again. Feel free to screenshot, take a photo, whatever you want. I'll leave them up here for now, and we'll do a little bit of a Q&A. James, are you about? Just give me a second.
Yes, I'm here. At the moment, I can't see any questions on the Facebook feed.
Okay.
Just give it a couple seconds to refresh. Although what we have been finding more recently is more people seem to be watching these after the event. So if people do have questions, even if you're watching it, a day later, a week later, do comment on the videos, because we do go back and check for questions, and we'll be able to kind of address any sort of concerns or queries that you might have. So yeah, still no questions on the video.
So that's fine, Tom. No Q&A this time. So if we do get any questions, if you're happy for me to sort of field them to you, then that's fine. But actually, I think what's been really, really useful is having your input when I've been discussing these things, because it's answered a lot and clarified a lot, which is really, really useful.
Thank you for having me.
Thank you so much for joining us. That was really, really helpful. So James, if you'd like to close up.
Yeah, of course. So just a quick reminder, I've posted the link for feedback, which is on your screens now. It's also in the comments on Facebook. Whether you take 5 minutes to do it now, or if you watch it, sometime next week, still please do, take a couple minutes, give us some feedback, give us some things that we can work on to improve it for yourselves, but also stuff that we can talk about in interviews, put in our portfolios, because, we do, these sessions are all free, and hopefully you find them very useful. I know I learn a lot each week. Yeah, and I believe that is everything. So enjoy the rest of your evening, everyone, and we'll see you next week.